Hi, guys. Welcome to the How I Raised It podcast, a show where we get an inside look at how real entrepreneurs and investors raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Courtney McRea of Recast Capital, a fund of funds that invests in emerging VC managers. Recast also runs the Accelerate program to boost women-led venture funds. In this episode, we talk about fund of funds, and we go deep into tips and advice for emerging fund managers, including how to raise capital from foundations, family offices, institutional LPs, and more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup, or Fundingstack.com if you are a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Courtney.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and Fundingstack.com. Today I have Courtney McRea of Recast Capital coming to us from San Francisco. How's your day going?
It's going well, Nathan. Thank you for having me.
Excellent. I hope you're having a good summer. Any big trips or anything fun?
Just got back from a long weekend in Tahoe before sending my kids off to 2 weeks of sleepaway camp. So I get some staycation time without the children for next 2 weeks.
That's a vacation in itself. Excellent. Well, let's jump into it. What is Recast Capital?
Yeah, so Recast Capital is a platform to both invest in and be supportive of diverse emerging managers in venture. We have three parts of our business. There is the venture capital fund of funds that actually invests in emerging managers in venture, institutional funds 1, 2, or 3. And then we have two GP-facing programs, Enablement and Accelerate, that are meant to be helpful to diverse emerging managers in venture to make their fundraising process more effective, more efficient, and maybe even a little more enjoyable.
Very good. How long have you guys been around?
We launched, believe it or not, in 2020, right before the pandemic. So we've been at this now for about 4 years.
And tell me a little bit how you got there. I was looking at your bio on LinkedIn. You've been in this industry for a while, but maybe tell your own story.
Yeah, so I've been in the private equity industry for my entire career, and most relevantly, for 10 years, I was one of 3 managing directors on the investment side of the house at a boutique venture capital fund of funds called Weathergage. And at Weathergage, we invested with brand name venture funds. But we also were always open to new names, to those managers that we thought could put up exceptional performance. And if you look at the performance, the underlying performance of those venture capital firms, there certainly are many brand name venture funds that have continued to put up exceptional performance. But there are others that the performance has decreased as the Roman numeral increases and the AUM increases. And many of our best performing managers were actually those that were early in their life. They were in funds 1, 2, or 3, because you're never more aligned with a manager than when they're raising their first fund or their second fund. And they're often more appropriately sized vehicles that have the potential. It's just math. Smaller funds are easy to outperform than having $1 billion fund. Yeah. So my former partners are a bit more advanced in their career, and they decided they didn't want to raise the next fund. And I left with the idea that institutional investors needed thoughtful, diversified exposure to emerging managers in venture to get the returns people are trying to get out of their venture portfolio, to identify the blue chip firms of tomorrow. And in addition, the emerging manager community is so much more diverse than the incumbents. And so I was fortunate that I reconnected with my now partner, Sarah Zilkowski, and she had come from an operating background. She had been at a venture-backed startup. She's an electrical engineer by background. and she was at the time the world's largest venture capital fund of funds platform, and she saw many of the same things that I did. And so we came together with the idea that we needed to create a product that institutional investors could invest in, but also a well-constructed fund of funds. You say no more than you say yes. And we wanted to be more helpful to this ecosystem than we could just out of an investment vehicle. We also wanted to prove to the market that Sarah and I could work well together, because we had never, prior to 2020, we had not actually worked together. And so that we started with our GP-facing programs.
Okay. We're going to get to the programs, but let's talk about fund of funds for a minute. And just for anyone who's maybe not familiar, kind of describe, what is a fund of fund? What is it and why does it exist?
So venture capitalists, for the most part, are very smart individuals, and they don't just use their own capital to invest in underlying portfolio companies. A fund of funds aggregates capital from variety of different sources. It could be public pensions. It could be high net worth individuals who want a more diversified portfolio. It could be family offices or foundations or endowments. And then they turn around, and fund of funds then invest it in a well-diversified portfolio of underlying venture capital or private equity or hedge funds, a group of managers. And you're trying to produce diversification through a number of different avenues. One is by vintage year. Usually it's 2 to 3 vintage years, a diversification. You also are providing diversification by underlying industry sectors. To the extent that you're overweight any underlying sector, you want it to be very intentional. You also want to provide diversification to a certain degree by geography. And then lastly, we don't provide that much diversification by stage, but some venture capital fund of funds do. We are predominantly early stage focused.
Yeah, interesting. What's the fee structure of a fund of fund? Is it similar to a venture fund where you're taking management fee and then carry, or is it different?
So it can vary. Standard run-of-the-mill fund of funds economics are you're taking a 1% management fee, which goes down over time, and then you are taking a 5% carry. Although, as you can imagine, these are all, it can vary depending on the size of a commitment that you get from say a public pension. Might get a slightly different economics.
Yeah, interesting. Okay, so the pitch or the hook or the theme of your fund of fund is that we're investing in emerging managers, and I believe there's a female or woman focused angle to it too, or maybe.
So we believe the data. We are looking for top performing managers, but we believe the data, and that is that venture capital industry is highly competitive. And to the extent that you see opportunities that others don't, or you have lived life experiences that others don't have, you're going to have outperformance. So we define diverse venture capital funds as at least one member of the senior investment team identifies as an underrepresented demographic within venture. And because one general partner or founding partner being diverse is relevant or meaningful is because these funds tend to be 1 to 3 general partners. So it's anywhere from 33% to 100% of decision-making and economics.
That's very interesting. So what kind of venture funds, give us some color and flavor on the type of venture funds that you're seeing that are interesting, that are catching your eye?
So if all you do is invest in venture capital funds, or all you do is invest in emerging managers in venture, I hate to say it, but it's almost there's a sea of sameness out there. They start to blend into one another. And what you're really looking for is a venture capitalist that is approaching the industry in a way that you haven't heard of before. Either they come from a background, a way that they can add value to companies that makes sense, it resonates, but you haven't heard that particular pitch before, or they're fishing in a pond that you hadn't really realized was an opportunity, but upon further reflection, it's an enormous opportunity. And so like to say that we're looking for contrarian, and then in diligence, you're looking for is it contrarian good or is it contrarian bad? Because they can be very close to one another. But when you hear a different pitch, a different story, a different way of approaching the market, it really sticks out. And that's where you double click and do a little bit more work.
Two-part question here. How do you get deal flow? Do you have to, does it come to you because you hung out the shingle as a fund of funds, so naturally people are flocking to you, or do you have to go hustle for funds? Second part of that question is, what do you see, what industries are you seeing that are interesting these days, and what is like maybe overplayed or just not interesting anymore, overdone?
So from a top-down perspective, we don't the word AI has gotten a bit overused. Everyone's got the name AI on their company at this point, and some of those valuations can be very high. But AI still is certainly of interest. I mean, it is going to influence many industries, and so we do want to have thoughtful investments that touch artificial intelligence.
Mm-hmm.
So I'd say top down, there are not categories that we're avoiding. It really comes from bottoms up. And understanding the general partners and the way that they see the world. I mean, it's so interesting. I mean, sometimes it's not the area that they're investing is really different. It's how they think about the industry. They articulate how they're thinking about their area of investment, and you go, wow, I've never heard that. That doesn't always happen, but that is interesting. What you have to say, I've never heard before, and yet it makes sense. And the examples you have resonate with that archetype. Those are the things that start to get more interesting, and you want to learn more. You want to better understand whether or not that's an interesting area to invest in. When it comes to, so one of the reasons why we did the GP facing side of the program is it does widen our top of funnel. It does allow us to see managers that perhaps we might not out of our traditional network. But then there's the other piece, which certainly there are funds that you have to know about through the LP community and through access to brand name venture funds to be able to know about those brand name spinoffs, because we had one of our managers that it was open and closed in 30 days, so you better be at the table or it's going to go away from you, and so you do need to do all the above.
What made that deal so hot? Open and close in 30 days. That's super fast for any fund. What made that thing so hot?
It really was because it was a blue chip spin out, and the brand name ventures fund that they spun out of anointed them. And so all the LPs who had the ability to invest in a spin out were interested in looking at it. And so I think that's what really caused it to be so quick.
Can you share the name, or you don't have to if you don't want to, but
no, not at this point. Yeah.
Okay, that's fine. So good segue to talk about your GP facing program. So what are they, and what do they do?
So Sarah and I are both institutionally trained investors in venture capital funds. And so what we are equipped to help them with is their fundraising process. And so it started with our enablement program. We keep it tuition free to be as inclusive as possible. And it's on Zoom also, so we can bring together GPs across the United States as well as LPs from across the United States. And we bring in our friends from the LP and the GP community to talk about how to make your fundraising process more effective. We will have different LP archetypes, talk about what they look for in emerging managers. We bring in GPs who not that long ago were emerging managers, and they can be introspective about what they did well that they want to pass on to others, and what they could have done better had they known more at the time. We also provide 6 sessions of executive coaching for free. It's kind of a lonely business being an emerging manager in venture. And then we provide space for them to get to know one another. So the emerging manager community is very collaborative. 1 + 1 = 3. And we create the space and the infrastructure for them to really get to know one another and to lift up one another and be a resource to one another. So the enablement program is sponsored 100% by sponsorship dollars at this point. We've worked with 116 funds to date. Of the 116 funds, 76% of them have had at least one member of the senior investment team that identifies as female or non-binary, and 63% have had at least one person of color. One of the learnings that came out of our enablement program is, yes, having there be no dumb question, Courtney and Sarah being straight shooters in terms of no bad question, and this is why you're getting the feedback you're getting. This is how you should react to this question or that question. That's helpful. The community is helpful. Executive coaching is helpful, but it still takes women and people of color 2 to 3 times longer to raise their funds than their white male counterparts. And so with the support initially from Pivotal Ventures, Melinda French Gates investment firm, we created a fiscally sponsored nonprofit that we call Accelerate. And we are doing cohorts of anywhere between 25 and 35 female and non-binary led funds. And we are doing all the things we were doing with our enablement program. And in addition, we are paying $100,000 of their operating expenses. And they agree in return to report, they invest in whoever they want to invest in, but they agree to report on the demographics of the founders in which they back. The hypothesis, of course, being that more diverse general partners end up investing with more diverse founding teams. Right now, only 2% of venture dollars go towards women-led firms, companies. And yet you find that if there are female general partners, the thought is roughly 70% more likely to get funding if you have a female general partner. So we are going to have a publicly facing report that will prove or disprove that more diverse general partners end up investing with more diverse founders.
Is it maybe it's too early, but is the data starting to play to that assumption or pan out to that assumption?
Yes. I think it's panning out.
Yeah.
Yes.
Interesting.
Yeah.
So this is probably gonna be a hard question to answer, but like from the enablement program, you've got your GPs who have raised recently and LPs coming in, sharing advice. What are some of your favorite nuggets of advice that comes to the surface in these programs for emerging manager VCs?
Yeah. So the big one is find your people. So if you talk to 100 LPs, you're going to be spun in so many different directions. Your fund size should be larger. Your fund size should be smaller. You should have a co-GP. You should not have a co-GP. You should raise a bigger fund. You should have a smaller fund. You should follow on in your investments. You should never follow on in your investments. And so the key piece of advice is spend the time upfront figuring out who you are, who you want to be, and then hold your ground and find your people. Especially if you're raising a more modest amount of capital, there's a lot of capital sources out there. So just as my husband always says, who's in the sales position, hang up the phone and pick it back up again. Keep find the people who your story, your background, what you want to be resonates with them, and raise capital from them. Don't try and twist yourself into a pretzel trying to be all things to all people, because it's just not feasible. The next piece of advice that I give all the time is, people learn that you need to have a diversified LP base. And I don't disagree with that premise. However, when you're raising a first-time fund, and sometimes even a second-time fund, you're trying to prove to the world that you're a good picker of companies and you've got access to and can actually invest in great companies. So it's a luxury to have a diversified LP base. And to make that point, I say, if a professional football player wants to write a check, you take that check. And if he wants to introduce you to all of his professional football players, you raise your whole fund off of professional football players. Just make darn sure that they know it's no liquid asset. But you can always diversify outside of football players for fund 2 or fund 3. But you need to actually prove that you're a good picker of companies before you have the luxury of diversifying your LP base.
Interesting. So prioritize your company picking over LP base. That makes sense. What are you finding for these emerging managers? Like how many like your husband's, I love your husband's quote. How many times do they have to pick up the call? How many LPs do they need to talk to land those folks, to find their people, so to speak?
So one of the other pieces of advice is if you're raising a $10 million fund, do not be talking to public pensions. So if you can start with figuring out the right LP archetype for your size fund, for your strategy, for your background, that helps you get ahead of the curve and spend less time, meeting with people that are never going to commit to your fund. And so the other thing that I've learned just through going through this process with these 116 managers is not always, but often, if you're raising a $10 million fund or $15 million fund, you can get on a Zoom call with a high net worth individual, and you might be able to raise $100,000, $200,000, $500,000 over a Zoom call, compared to institutional investors that tend to have consultants, or they tend to have an investment committee or a full process. So the other thing that I've come to learn is that corporations are incredibly active in investing in emerging managers. Often they want to see what early innovations are taking place in a certain sector. Often it's corporations that are in your ecosystem. So if you are a health tech fund, it could be the health institutions that want to see that deal flow, want to see what innovations are taking place. We even had one of our GPs that raised $10 million from Victoria's Secret. I'm not saying Victoria's Secret has an active investment program, but if you can get to the right person in some of these corporations, I don't want to pick on Victoria's Secret, you can unlock capital. And it is confusing to figure out who within these larger corporations are the right people to talk to. But I do think that they've been very active, and corporate venture capital funds have been very active in investing in underlying venture companies, even in this ecosystem. The last thing is, the federal government has bestowed an enormous gift on emerging managers and diverse emerging managers, which is the SSBCI capital that's being allotted at the state level. And so a lot of emerging managers are tapping into that for funding.
Where would they go? Where would you point them to find out more about that?
So I think the easiest way to learn more about that is from NVCA, the National Venture Capital Association website is the easiest way to navigate. You can see how much capital each state has received and who's actually managing that capital on their behalf.
To go to NVCA's website and search for state managed.
Yeah, I think it's just under I'm sorry, I don't know the exact, but you can find it in there, and it's a much easier website to navigate than trying to go to the federal website, which has much more information. It's where I would start, and it'll be easy to find if you go there.
And what was the acronym? SBIC? No, it was something else.
SSBCI.
SSBCI. I'm glad I asked. Okay, SSBCI. That's new to me. Kind of in related vein, for emerging managers. Another two-part question. Should they really mostly be talking to high net worth, some family offices? What's your opinion on family offices? I mean, I love the corporate venture idea. That's interesting. But what do you think about family offices for first-time funds?
They often are. That's exactly where a lot of them are raising their capital from. The other group are foundations. So foundations, one of the things that happened during the pandemic is that many foundations who are doing really great work on their philanthropic side of their organization, they said, you know what, we really need our investment side to reflect our values from the philanthropic side. And so to the extent that you scratch an itch that this foundation has on the philanthropic side, and now you have a venture fund that's focused in that space, those are going to be better targets for you for capital.
We'll move on in a sec, but what do you think about institutional investors not likely to come into your first time fund, but should you reach out to them? Should you start to try and build a relationship? Is it too early? If you're raising your first time fund, are you wasting your time and their time? Or how do you play that out?
So there are very different emerging managers. If you have a track record and you've proven to the world you're a great picker and you've got a great track record, even as a fund one, you can raise money from institutions. If you're spinning out of an established firm, those folks, even fund ones, are raising money from classic institutional investors. It's the managers that don't come with that type of a track record. And those managers, I would say it's not worth your time. Figure out who you are, get your pitch down, get your vision down, learn a few things before you. It also is very time consuming because a lot of institutional investors will take a first meeting just to know what's going on out there. And yet, if I'm raising a $10 million fund and I'm talking to an institutional investor whose minimum check size is 20 million, and I've never backed a fund one before that wasn't a blue chip spin out, it's just not a good use of your time.
Should you start to build relationships with those folks as you're halfway through investing fund one? When is the right time, I guess?
The right time to be raising a fund is when you're not raising a fund.
Sure.
You've raised your capital, and now I'm not a threat. I'm not asking you for money. I just want to let you know what I'm doing, what I'm building, and start building a relationship when you're off cycle. Because the dirty little secret is you're always fundraising. You're fundraising even when there's not a fund to invest in yet.
Very cool. We have a platform for emerging managers called Fundingstack, and I'm seeing a lot of interesting. I feel like the market's exploding for emerging managers, right? Is it hard to? Are you overloaded with deal flow? Or maybe ask it that way. Like, is it?
I will tell you, every time we open up applications for either enablement or accelerate, I keep waiting for us to have gotten to the end, that there are no more emerging managers that we haven't met. And yet, to your point, it feels like it's a never ending. And part of that is because the barriers to entry are so low. And I mean that lovingly, but you can come to this industry from so many different backgrounds. You could be a guru in a specific industry. You could be a guru in artificial intelligence. You could be great at recruiting. You could be great at go-to-market. You could be great at helping companies with their PR strategy. There's so many different ways that you can come into this business, as opposed to, in contrast to buyout, where you need to ideally come from business school. You ideally have worked you know how to work an Excel spreadsheet. You know what debt is and how it impacts these companies. Venture capital just has much lower barriers to entry.
Yeah. Are we at peak venture? Are we oversaturated in emerging managers, first time funds, or what's your?
So I do think, when you have market corrections like we're seeing now, when accessing capital is harder, that's when there tends to be individuals that say, you know what, I think I'm going to go back to where I came from. I'm going to go back and have a more traditional job. It does take a minute, because if you raise capital and invested capital, now what do you do? Because these are 12-year, 14-year relationships with your LPs. And I have heard a little bit of rumblings of, is there somebody I could sell this to? I think that's very, very hard. I think you have to, when you sign up to be a GP, you are on the hook personally for 14 years. And so
that's a lot of people don't actually. Yeah. Yeah.
Even if you take a day job, you have a responsibility to the investors that have given you capital to manage that and be a good fiduciary.
That's a good point. I never thought of it quite like that. All right. Any other advice that we haven't covered, tips, nuggets that you like to give emerging manager folks coming in your door?
Yeah, the other piece I say is leverage other emerging managers. It's a collaborative community. Be collaborative with it. We have seen so many innovative things that have happened with two GPs from two different firms coming together to make introductions to their LPs, to do joint dinners where they each bring, a group of, their investors or people that are close to them. This idea that, 1 + 1 really can equal 3. And you should really leverage the community, because it's a really collaborative community, especially the diverse emerging manager community.
Yeah, I like it. Very cool. All right. I think you mentioned before our call, you've got an Accelerate cohort, or what do you want to plug?
Yes. So, as I mentioned, we right now are working through the applicant pool for our second Accelerate cohort. Next year, we will be opening up applications for our third cohort. So, if you are a female or non-binary led emerging manager in venture, please keep an eye out for when applications are open. And then, lastly, if you are a limited partner who is interested in getting access to these diverse emerging managers in venture, we'd love to bring you into our ecosystem and have you involved with our Accelerate and our enablement program.
And if anyone is listening that fits those groups, where should they go?
So you can find me on LinkedIn, Courtney McRea, MCCREA at Recast Capital. I'm very active on LinkedIn. And then certainly our website has a lot of information about who we are, and that's recastcapital.com. And that's also where you can join our newsletter in order to know when applications are open for the next Accelerate cohort.
Got it. Okay, so sign up for the newsletter and then look for that application date and link in there, basically. Awesome. This is really interesting. I always judge based on how many notes I've taken, and there's 2 back-to-back pages of notes. So good stuff. Thank you very much. And I'd love to maybe get you on again at some point, to hear how the model's evolving and how the industry's evolving. So, but congratulations and appreciate your time.
I appreciate your time and happy to do it again. So, but thank you for your time and for doing these podcasts.
All right. Thanks, Courtney. Over now. Bye.